Thank you so much for gathering here today. This is our media lunch for Atlanta Society of Finance and Investment Professionals. And we have our panelists from the industry. And as well, we're going to cover the results of the member forecast survey. So our members are predicting for 2018, for the year end, that our market is going to grow. And it's going to grow 5% in terms of price return from current levels. And fewer than 20% of participants expect that S&P 500 is going to be behind its current level. The 10-year Treasury yields are generally expected to rise, and 86% of individuals are expecting yields to remain at or above 2.6%. And our members also expecting U.S. dollar weakness to continue in 2018. There is a broad range of expectations on the Fed funds rate. On average, the rate increases are anticipated up to 2.75%. In terms of best performing asset classes, emerging markets, international investments are the most frequently listed asset class as the best performing one. However, we have a wide range of responses. In terms of worst performing asset class, gold is expected to be the worst performing asset class. And now for our panelist. Greg Silberman, he is the Chief Investment Officer of ACG Wealth. He is responsible for managing the firm's global investment portfolio, as well as supervising the implementation of the company's asset management strategies. Prior to joining ACG, Greg served as Director of Alternative Investments at Wilmington Trust. He has worked as a portfolio manager, analyst, and product developer for Perpetual Investments in Sydney, Australia, and JP Morgan Chase in London. And he was focusing on structured derivative products. Greg is a chartered financial analyst and a chartered alternative investment analyst. Stephanie Lang, she's a principal and chief investment officer at Homrich Berg Wealth Management. She joined the firm in 2005 and was named chief investment officer in 2014. She oversees a team of professionals within the investment department and is responsible for all investment matters, including asset allocation, selection and monitoring of traditional and alternative investments, as well as the research efforts. She also chairs the firm's investment committee. She has 20 years of experience in the investment industry. Prior to Homrich Berg, Stephanie was a portfolio manager for Bank of America. She went to school to Georgia State University and for MBA and has a bachelor's degree from University of Georgia. She is also a chartered financial analyst. Ben Webb, he is a director of manager selection and implementation of Balentine LLC. He also serves on investment strategy team. He oversees manager research, strategy design, tactical asset allocation, and internal investment communication. Prior to joining Balentine, he spent 2 years at Willis Towers Watson, working mostly in investment consulting with institutional clients. He has a bachelor's degree in finance from Kennesaw State University. Thank you so much for being here. Thank you.
So we're going to go backwards, and then why don't you start us off, and we'll work backwards.
Great. Yeah, when we think about 2018, we're really looking at a couple things to keep our eye on. And the first thing, and probably the most important, is to acknowledge that bull markets don't die of old age. Right? There's something that comes along and stops them, whether it's policy misstep in Washington, runaway inflation. There's something that's going to have this market end. And it's been well noted that this is the second longest bull market in history. It's the fourth strongest bull market in history. And so there's a lot of talk about, okay, it's very expensive, high valuations, it's time to be afraid. But while valuations are a gauge of kind of where you're at, you don't want to make allocations based on that. If you were to, for instance, in the 90s, if you were to say, okay, I'm going to sell at the same level as the Great Depression, you would have sold in mid-1997 and missed 50 to 70% more of the market. So, yes, markets are a little expensive, but really listen to momentum and to tell you where the market's going. And, you know, when you start to see the drawdowns happen and the more of the fear occur, you could be a little more cautious on your equity position. But until that happens, I would say just keep at it. The second thing we're looking for in 2018 is really try to figure out tax reform. Is tax reform going to be junk food for the market, or is it going to be nutrition? What do I mean by that is think about giving your 3-year-old a packet of Skittles. They're going to run around for 15 minutes and pass out. And that very well could be what tax reform is if it does nothing but cause companies to push money back to investors, buybacks, or one-time bonuses, you could see a spike in the market, but it's not going to be long-lived. What we really need is the nutrition. And what I mean by that is if tax reform actually causes companies to make those long-needed capital investments and to really try to push towards productivity growth, you can actually see a more sustained reaction from the market due to tax reform. So that's something we're trying to keep a close eye on. The next thing we're looking to do is try to find returns outside of U.S. tech. It's been well documented that FANG stocks have done amazing, since 2014, and just being in that, you would have done better than most. But 2017 actually was the first year that we saw international assets outperform U.S. assets, whether it's emerging markets or even small cap. They both outperform large cap growth, and so we're looking for 2018 for that trend to continue. And the reasoning is simple: is U.S. did a very good job of coming out of the recession with a lot of quantitative easing and good monetary policy to push the market back. The rest of the world has been lagging. They are just now doing that now, and so you see that coming to fruition. And so the valuations are much more attractive, and flows are heading there. So that trend can very well continue in 2018. The next thing we're telling people in 2018 is when it comes to fixed income, just keep it simple and keep it high quality. We believe that investors own bonds to have the courage to own stocks. And we really look at it as a shock absorber to the rest of your portfolio, where you can go out and gain growth. And in order for that to happen, in order for the traditional relationship for when stocks sell off, bonds do well, is you really need to own the high quality stocks or high quality bonds. We don't recommend within bonds looking for returns such as high yield or even emerging markets. Those spreads are at cycle lows, and what you're getting paid to own a high yield bond is in our mind unattractive. And so keeping it high quality, keeping it simple, will allow you to, when that market correction does come, you can sell your stocks and go into your high quality bonds, and that will be the ballast to your portfolio that you're looking for. The next thing we're looking for in 2018 is what we're calling the return of return dispersion. Since the bottom of the crisis, all stocks have been very close to each other. It's been very hard to beat the S&P 500 or Russell, whatever your benchmark is. It's been a tough go for active managers, whether they were stock pickers or whether they were asset allocators. What we saw in 2017 was a breakdown in those correlations of stocks and asset classes, to where we think that 2018 can actually be a pretty fruitful year for an active manager that's stuck to their knitting. And so if you're holding on to an active manager that think, I know that she has a good process, but her returns haven't been good, 2018 very well may be the year for that strategy. And the last thing that we're telling people is to watch cryptocurrencies from the sidelines. It's very exciting to watch an asset class be born and die all in 2 months. But we believe that eventually cryptocurrency will have a place in portfolios, and we're taking an approach of the dot-com boom and bust. You think about the clicks and eyeballs and the pets.com, those were very great at the time, but they came to a fantastic end. And we believe, just like Cisco, Amazon, and Yahoo were able to pull themselves out of that bus, there will be cryptocurrencies that will do that. And in a couple years' time, there can be some very interesting investment theses around those. But right now, just kind of stay on the sidelines. So that's how we're looking at 2018. The biggest thing, though, is don't be afraid of stocks as long as the strength is there. And even if the strength goes away, I think we all cut our teeth in .com boom and bust and the housing boom and bust, to where these great bull markets come to just fantastic ends where they're down 40, down 50%. But if you look over the past 40 years, that's not really the norm. We've had 8 drawdowns over the past 40 years, but 6 of them have been 1 to 2 year blips, and the latest being 2015. And so just because this bull market is coming to an end, it doesn't have to come to the end that we saw in 2000 or 2008. So remain vigilant, remain cautious, but as it stands now, remain invested.
Thanks for having me here today. As you guys mentioned, I'm with Homrich. We're wealth management right down the road in Atlanta. We've been around since 1989, and we have over $500 billion in client assets. So while we're not in the business of being short-term predictors of what's going to happen, we definitely keep a close eye on what's going on in the economy and the markets, and those views do shape how we're investing client portfolios. So I'm going to touch on a few of those today, and I agree with a lot of what Ben said, and I'll kind of contrast in some areas that were different as well. So to start off, the big thing I think that's in everyone's mind is, this bull market's been going forever, and when is it going to come to an end? And one of the big things we're watching is recession. When is the next recession? And the good news is we don't think there's going to be one in 2018. All the economic indicators are still strong. 2017 was a theme of global growth throughout the world, and we're going to stay put for now. One of the things to note is, why is recession such an important predictor is that if you look since 1957, there's been 9 recessions and 9 bear markets. And bear markets would be defined as, losses of 20% or more. So this is the big thing we're looking at. There have actually been 3 times, though, that there's been a recession without a bear market, and then there's been 3 times that there's been a bear market without a recession. So nothing's perfect, but this is a big thing we're watching, and it has been a strong predictor of the big declines in the market. Similar to Ben, we're staying put with stocks. We're not selling yet, and one of the big things is PE ratios look like they're at record highs, depending on which ones you look at. But one of the big drivers of returns in 2017 was earnings growth. And you saw, big earnings growth in the U.S. Things are still rolling in, but it's supposed to be around 9%. And actually, non-U.S. earnings were over 35%. So you can see what drove the market. And while we think that that's probably going to continue in 2018, we think earnings growth is going to continue this year, and that's going to be the overall driver of stock market returns. The third thing we're talking about, similar to what Ben said, is don't fight the tape. So the way we like to say it is, the stock market's going, let's not fight it. And so we're not going to make allocation changes solely based on momentum, but we'll combine that with the recession risk and valuations. And if we see a couple of those turns, we will lighten up on equity returns. The fourth is don't forget to diversify. So, if you talk to our clients 3 years ago, everyone said, why do we own international stocks? Are you guys idiots? And, but last year was a good time for international stocks. And, we think that can continue this next year. Valuations are better abroad. The other thing is, bonds. Everyone's saying, well, interest rates are going up. Why do we continue to own bonds in our portfolio? And We think those are going to be a good volatility reducer when the stock market does turn over, and so we're staying put there as well. But where we differ a little bit from Ben is that we are taking some opportunities to take on some credit risk in our portfolios. Not necessarily high yield or emerging markets, but we do have a pretty big mortgage position that adds to the yield of our portfolios. And just getting that higher yield in portfolios we think will protect against rising interest rates, which we think are a big possibility in 2018. And so I'll just kind of wrap it up by saying, while we're optimistic for returns in 2018, longer term we are a little more bearish. And the way I like to explain that is there's a couple things that tie to longer term returns, and particularly 10-year forecasts. And one of the indicators is valuations, and as we talked about it, stocks are expensive. And so we think longer term, if you look at 10 years out, stock returns could be half of the historical average. And if you look at the bond side of things, yields are often a good predictor of what bonds will do in the next 10 years. If you look at the ag, it's less than 3%. So combining those things, we think that returns are going to be lower going forward. And so we're telling clients that they need to rein in expectations as far as what's going to happen over the next 5 to 10 years. And that's important when people are planning for retirement. And one of the things that we're doing to try to help boost returns in client portfolios is look at alternative investments, particularly look at private assets. And so we're looking at areas that can provide returns over the public markets as a way to provide returns for our clients. So that's it. Thanks for having me here today.
Thank you, and good afternoon to everyone. Thank you for having me here. My name is Silberman with ACG Wealth. We feel at ACG Wealth that 2018 is potentially the year that will be looked back as the beginning of the reversal of interest rates towards a higher interest rate environment. We have come through now a 30-year secular bull market in bonds, i.e. interest rates have been declining for 30 years. And we came across a good study by an analyst at Smith Barney. Her name is Louise Yamada. She used to be at Smith Barney. And Louise looked back at US interest rates going back over 200 years. And what she noticed was that there were predictive cycles in interest rates. So you'd go through a secular bull or bear market, and then you wouldn't necessarily get a V-shaped reversal in those markets. What would happen is those markets would then base for another decade or so before they reversed higher. So it seems like we've now passed that decade of low interest rates just basing, and that we're starting to move higher or to trend higher. And we can certainly see that as we speak today. I think the 10 years about 2.7, and it's really just been marching higher since the elections in November of last year. From a fundamental perspective, the issuance of fixed income securities have never been higher. In 2017, there was $1 trillion in issuance. In 2018, there's scheduled to be $1.5 trillion, going up to $2 trillion in 2019. The sources of issuance are, per the Congressional Budget Office, the regular U.S. deficit to finance. There's the tax cuts, the Trump tax cuts, which need to be financed by increased issuance. There's a lot of maturity in liquid, in investment-grade bonds and high-yield bonds, and as well as the tapering of the QE program. The fine print around that is that maturing bonds are actually going to be rolled forward per the system open market activity account. So a lot of issuance still to come, and that is definitely going to be pressuring interest rates higher, whereas it could be gradually or it could be at an increasing rate. At ACG Wealth, we went back and took a look at 12 of the prior rate hiking cycles. So here we're talking about Fed rate hiking cycles going back to, I believe, 1948, which is the first rate hiking cycle post-World War II. So the interesting aspect of that is that during those 12 cycles, the market, measured by the S&P 500, was up 10 of the 12 years. Only 2 of those years were actually negative years on a calendar year basis. However, and this is data that has actually been acknowledged by BlackRock. So we make use of BlackRock's Aladdin risk management tool, which tracks over, I believe, $7 trillion worth of wealth. And Aladdin has indicated that the average wealth or average client portfolio, whether it's institutional all the way to high net worth or retail, is overstocked with high price earning stocks. So we've all somewhat gravitated towards technology, healthcare, the FANGs, as one of my colleagues mentioned earlier. The problem with the way those portfolios are structured today is that during a rate hiking cycle, stocks that do well are typically not going to be your technologies, certainly not your real estate or utility stocks, which are high in leverage. And the reason around technology and healthcare is simply that as the discount rate increases, it makes volatile earning streams less valuable. And certainly technology, healthcare tend to be more volatile earning streams. So at ACG Wealth, we prefer to be cycling more towards the value side, and we're certainly seeing this growth, this rotation now not out of growth, but certainly a rotation from growth to value. Going into 2018, we like the financials as we see the yield curve steepening. We like your old industrial conglomerates, and we certainly like the commodity producers, whether they're energy or the miners, because higher interest rates are normally accompanied by higher producer prices, which for us indicates natural resources may be at the bottom end of their secular bear market. There are some specific themes which we are focused on going into 2018, and some of them are well documented in the media. So again, one of my colleagues mentioned cryptocurrencies. That's not really what I want to speak about. What I want to speak about is the underlying technology of blockchain technology. So some of you may remember the old Napster file sharing program, whereby you could download music, and Napster was closed down, rightly so, for copyright issues. But the distributed ledger, which is what blockchain is basically saying that in this day and age of massive computer hacks and hacks such as Equifax, you need some kind of trusted source within computers, within PCs, within technology. Blockchain is that technology because it gives you the capability of storing irrefutable evidence in thousands of different computers, which make it virtually, not totally, but virtually impossible to hack. Meaning that the blockchain technology is really technology which is going to solve a lot of the hacks that we see today, or it's basically a really big technology that's going to change a lot of things, and we feel that's underestimated right now in the market. The other sector that we've been looking at, and we've actually done well for clients in, but we think the theme will continue, is the aerospace and defense industry. We feel like 2017 maybe looked back as the year when Americans once more became aware of the fact that a nuclear bomb can be detonated in the United States. And here we're looking at a tiny little country called North Korea, which is essentially menacing this superpower called the United States. And no longer is the moat of the Atlantic Ocean or the Pacific Ocean, this geographic moat is no longer applicable to the US. What we did notice when President Trump traveled to Asia, one of his comments to many of his to the government colleagues in foreign countries was that they should consider investing in US defense and aerospace industry as a way to balance their budget deficit with the US. So that's kind of a tongue-in-cheek way, but certainly there are countries that are concerned with North Koreas of the world, and there is an arms race occurring right now, and that's an area we're looking at. The other area which we think is a lot closer to coming to fruition than many believe is the autonomous vehicles and the electric vehicles. Tony Seba, who's a futurist from Stanford University, recently gave a great lecture. It's available on YouTube on clean energy disruption. Tony speaks about 3 disruptors that are occurring at the same time. He talks about ride sharing, such as Uber. He talks about electric vehicles, which are essentially have essentially created to do 500,000 to 1 million miles versus an internal combustion engine, which is going to do 150,000 miles over its lifetime. And thirdly, the technology, I don't know if anyone's ever seen an autonomous car, but it has technology at the top, kind of almost like a siren. That's called a LiDAR. A LiDAR is a cross between a laser and a radar. In 2014, Google said their LiDAR was valued at $150,000, that was its cost. In 2016, a company came out with the LiDAR, the solid-state LiDAR at $250. So those three disruptive technologies are all occurring right now to create autonomous vehicles. If you go to Singapore and you catch a taxi ride from the airport, the Singapore airport into the city, there will be an autonomous vehicle. So that's a theme that we're following closely because we feel it's here right now. And finally, on the contrarian or negative side of the ledger, we've noticed that the issuance in consumer debt has never been higher. And here we're talking about credit card debt, student loans, and auto debt, specifically subprime debt. We've noticed that the large financial institutions, the JP Morgans, the Wells Fargos, have been increasing their loan loss ratios against bad loans in their books. And we're certainly out there looking at various providers that are going to help us acquire some of these distressed loan portfolios when they become distressed and work them out. And one interesting aspect of that is we're looking at some VC companies that have got access to loan servicing technology that will be able to take loans, load them onto their technology, and work them out at more advantageous rates than what exists. So that's what we're following at ACG Wealth, and we're very excited about the prospects for 2018.
Excellent. I have a couple of questions to start us off, and I'll actually let all three of y'all answer them. Ask all three of you too. I'll start with Stephanie, since you were in the middle last time. And then we can open up for anyone that has a question. My first question, I'm going to piggyback right off what you said about the high debt. I think that's also associated, I think I read recently yesterday that there's a low level of savings right now, and part of that could be due to, my question is, how much of that, Stephanie, the low savings rate is due to the fact that we're currently sitting in an environment where we have very low interest rates, and we now have people that have come through the system that don't relate, right, they didn't have that experience that we had when we were young of saving and actually earning interest because there is no real interest to be earned. And how does that impact things for the future?
Yeah, I think it's a good point. You know, it's very telegraphed that the central banks, the Fed, they've been, pushing down interest rates just to push investors into riskier assets, which has fueled the stock market for the past 9 years. So, they've accomplished that. We've seen big gains. And to your point, I try to get my daughters excited about savings, and I'm like, I put in and you've earned 17 cents this year. So it's not quite the same as it used to be. And I think, it'll be interesting to see as interest rates move up, and we were actually just talking recently that, it's not that exciting, but now that you can earn, 1.5% on cash, it's real return. It's nothing to get super excited about. But, as rates move up, I think you're gonna see some flow back into cash, and you'll see, investors waiting on the sidelines for the next downturn. So.
What do you think?
Yes, it's been a well-documented issue, and it's really sacrificing the middle class and their ability to save for retirement for for big stock returns. I think everybody can do the easy math on a 0 interest rate or even a 1% interest rate. I'm going to save $1,000 in a year. I'm going to earn $10. I'm going to go recycle aluminum cans. But I also think there's been a shift in mentality about these younger generations and how they're going to create wealth. A lot of people, it's like, I'm not going to save, I'm going to, make an app, or I'm going to join a venture capitalist firm. And so they really have been focusing on, putting away dollars and cents, but really trying to, how can I make it big? And everybody's seeing, what happens when Mark Zuckerberg makes a cool website and is now with $100 billion. So I think that's been kind of, tainting the idea of why save when I can just work hard and strike it big.
Yeah, I don't have much to say compared to my colleagues here. I mean, certainly, as Ben points out, the middle class has been hollowed out to a degree, or if not so hollowed out. The cost of living really is prohibitive towards a large savings rate with the middle class. And then in addition to whatever is saved is really pushed into higher risky assets just because there is no interest to be earned on low interest assets. So I'm sure the middle class would certainly like to save more, but just is unable to. Certainly in the United States we have more of a consumer-driven environment. We don't richly reward the savers. I recently came across some statistics around Chinese savers. I mean, Chinese, if I'm not mistaken, saves up to 20% of their disposable income. So certainly a bit of a different cultural aspect to it. But these ultra low interest rates have definitely affected people's ability to save and desire to save.
As a follow-up, just out of curiosity, if you remember, was that the Chinese, the 20% or up to 20%, was that a function of what they were told they should save? Was that a cultural phenomenon, or what do they say was behind
It's very endemic in their culture to save, first of all. Second of all, there's no social net, so to speak, in China. So you really have to rely on parents, grandparents, and extended family if anything bad were to happen to you. So it's really endemic into the society.
Okay, and then last question from me, and then we'll throw it open, is what do you think the one you force people to get, what's the biggest risk for 2018? And Ben, we'll start off with you. You're welcome.
I would say that the biggest risk is trying to get too smart with the market. I think that there's going to be a lot of talk around geopolitical risks, and then that's spooking the market, but history has shown that those are short-lived. Look back in July 2nd, 1997, when the Thai baht came unpegged, it put emerging markets in this frenzy, but it was really just a blip. And if North Korea tries to invade South Korea or do something unforeseen, it's going to spook people, but those tend to adjust themselves quickly. And a risk could be taking drastic action on something that isn't long term.
I would say the biggest risk is that inflation surprises to the upside, and that would cause the Fed to raise rates quicker than expected. The Fed's done a really good job at really telegraphing what they're going to do, and it looks like the Fed futures are right in line. But if something were to happen where wage growth is higher than expected and inflation really ticks up, and then the Fed really has to lay on increases faster than expected, I think that would spook the markets. In addition, higher rates could hurt corporate earnings faster than expected, and that could also have an effect on the stock market this year.
So the biggest risk is always the risk that you don't identify or can't identify. But again, I will agree with my colleagues, and I've spoken about interest rate risk, inflation risk, and geopolitical risk. The other risk that I will throw out there, which no one has mentioned, is certainly political risk. That we've got a president, and I don't know what he's going to say next. I don't think anyone else does, and certainly there are elements of there's talk of impeachment or potential and all that kind of stuff, which is just out of left field, and there's no way of predicting it.
Excellent. People at the table, any questions? No, I'm sure Marlene has some.
So as baby boomers are retiring and getting from accumulation to spending phase, and you mentioned, Stephanie, that the returns are going to be lower going forward, what would you advise, or what would you suggest they should do as they go through this challenging environment in bonds and stock market? And this is for all of you.
The way we work with clients is that we're going to look at everyone's specific circumstances and look and say, okay, what are you spending? What's your life expectancy? And so we're incorporating that returns are going to be lower going forward. And if you have a 10-year horizon, I think you need to be a lot more worried than if you have a, 20, 30, 40, because I think things will come back around like they always have. But I think, we've been in such a hot market for this past 10 years that I don't think it's, going to continue for the next 10 years. So what I would say to clients is that you may have to adjust your spending potentially to account for these lower returns. And sometimes you may have to take on a little more risk knowing that you have to generate some higher returns. So we're going to look at each instance, on a personal level and decide, what's best for the client.
And I would say to consistently keep up with your desires and your spending. If the technology out there today, whether it's e-money or Riskalyze or other financial planners, you can on the fly adjust, do I want to buy a boat or do I want to buy a pontoon boat? And that will affect how you work to retirement. I think there's no hiding from this idea that returns are going to be muted going forward simply from the starting point that we're at today. But my guess is there's going to be some creative solutions that are going to be out in the market that will help address this. One, we're talking with a firm that is working with an insurance firm to allow investors to buy retirement insurance. And what that means is, if you think your money is going to last you from 65 to 85, you can buy a policy that will pay you from 85 till death. So creative solutions like that will really start to address this. And what we know is that when there is issues rising, which this baby boomer is going to be a big issue, is that there's a lot of incentive for people to solve it. And so I would say keep up to date with where you're at, but stay nimble and get creative if you can.
So the first thing I would say, I will challenge the whole concept of retirement to begin with. Okay? So retirement itself is actually a invention or concept of the industrial age, first of all. So the retirement age of 65, 70, whatever, in this day and age is a little bit meaningless. With all due respect to people who retire, it's not meaningless. But I say that in respect of, 65, 70 today is not what it was 10, 20 years ago. And what we see with medical science, we're going to live a lot longer than we believe. So the retirement issue is going to be a bigger issue than just earning returns for the next 5, 10, 20 years. But that said, there's no silver bullet. There's no magic bullet, right? You either have to work longer to earn more money, go further on the risk spectrum to make your investments work harder for you, and that's probably not what we would advise, or curtail your expenditure. So it's really a mathematical formula, and that's it.
No, for the answer. We don't like that. We like that. Appreciate your honesty. I have questions.
What are you telling your clients about the Tax Cuts and Jobs Act and its impact on their investments?
Or I can go. Either one. I would say, it's very interesting because as soon as the market started anticipating that it was going to pass, everything went into motion. You saw the sector rotation with the companies that were going to benefit. You saw the interest rates going ahead and moving. So I think a lot of it has been priced in. It's interesting to see though that on the pass-through, and again, I'm more the investment person than the financial planning, but no one really knows how that 20% deduction is defined. And so I still think that, there's still some things to be worked out or things to, that we need to learn about it. But as far as from an investment standpoint, I think, the proof is in the pudding. It's kind of already been priced into the market. And I think you will see, as earnings have been rolling out, you've seen these one-time charges and some of the estimates going up. So I think, longer term, that will help PE ratios to normalize a little bit this year.
Yeah, so I'll echo the fact that it's specific to each client's situation. But I will mention one thing that I came across in the Tax Act, which I found not well trumpeted, and pretty interesting. So there is a limit of 30% interest deductibility, 30% of earnings, which basically says to me that if a company is highly leveraged, there may be an element of interest expense which is now not allowed for tax deductions. Which is interesting from the perspective of, well, what are they going to do with the excess debt? And I surmise that a lot of the repatriation is actually going to be repatriated funds that is overseas, that will be brought back, may be actually used to pay down debt instead of to do stock buybacks or capital investments. So to me, that was something that I think is going to be bigger than people had measured.
Right, and as as I mentioned in what we're looking for 2018, we hope that this tax reform causes companies to go and invest in new technology and capital improvements to actually move that productivity growth up. It's well documented that productivity growth has been lagging for a long time, and if that can actually cause that to happen, then it could provide a sustained tailwind for the market. But other than that, it's too early to tell how that's going to play out. And to Stephanie's point, remain diversified, remain hopeful, but don't be too naive.
I actually have two questions now, Greg, just to your point about the 30% cap on deductibility. Do you think that could possibly impact global fixed income for companies that are global that don't get all the deductibility in the U.S. and do they issue more overseas if they have their happy assets and they match more asset liability matching outside the U.S.?
I'm not sure I follow you exactly. If it's a US-based company, it doesn't matter where the debt is issued. They'd want to deduct the interest, on their US tax liability. So I estimate that with that in place, they're probably better off just reducing their overall corporate leverage instead of issuing new bonds, and perhaps just surrendering some debt as a result.
And then the question I have is around sectors. We talked about this a little bit. You mentioned financials and industrials and commodities as well, which are all ratified. So it's great to hear you talk about with there. Are there other sectors that you see as opportunities in that area?
We're mainly focused on the energy sector, and again, we have a very quantitatively driven approach to investing. And our sector model looks at long-term underperformance, attractive valuations with short-term momentum, and that's really where the energy sector plays out. And it's just been such a dog for so many years. But given the possibility of a late cycle commodity run-up with just a complete lagging the rest of the market, energy could be a really interesting place to be. And other than that, if you believe that financials are going to do better with rising interest rates, then that's a place to play. And then if you believe that FANG still has another 200% to run, then I would say allocate it to tech.
I would just throw out one that I mentioned a little bit earlier, that some of these industrial conglomerates, these old sleepy industrials, they look interesting to us, and I would say with any sector allocation, I'd really want to be focused on what disruptive technology is going to reach those sectors. And industrial, certainly manufacturing and 3D printing, that's a big deal. And I think that's got the potential to disrupt some major manufacturers.
I would echo on the energy side. We're more specific. We've had an investment in MLPs. It's been really tough in 2017. They've been off to a roar this year, and they have strong distribution growth. They've been undervalued. You can't really say anything's undervalued in this market, but that's one area that I think you can. And then, the other place, we really like dividend payers still, really on the dividend growth side, and we think those will hold up better if there is a downturn, but they're definitely like high quality companies that we think will outperform over long term as well.
Any more?
alternative investments, where do you guys see opportunities? Second follow-up question, what do you think about real estate?
I'll start because I love alternatives. I'll start with real estate because you asked about that. I would say that most real estate sectors are in late cycle. Some are even in the decline. So, we were really heavy into apartments 5 years ago, and now we basically all but pulled back within a couple years. There's a couple sectors like suburban office we like that still has some room. You can still get really nice yields and decent entry points. But overall, we're pretty opportunistic on the real estate side just because the cap rates have compressed so much, and we've seen a really big run there that we're really being picky on the real estate side. On the rest of the alternatives, I think it is a good place to look at because you can get some excess return over public markets. And so we encourage clients, if they're willing to take on some illiquidity, that they should take some positions in private markets, whether it's private debt, private equity, private real estate, private natural resources. And on the opportunistic debt side, that's a great place. If a 2008 were to occur, they can go in and scoop up all those cheap assets. So, and then the last place is hedge funds. Those have been a bad word for quite a long time. Ben mentioned the dispersion in returns, which have actually been finally have come to a big high. So everyone, all these poor active managers out there that have been losing assets, hedge funds, which have been a bad word, we think they're actually in a great position going forward, given that there's been more dispersion in stocks. And we think that, given that they can go long and short with that dispersion, that's helpful and can be a good addition to portfolios for those return opportunities, but also volatility producers.
And the way we look at alternatives is really try to hone in on is it an alternative risk premium? Is why are you getting paid to own this asset? We run two types of portfolios. One is just simple stocks and bonds, and one with those alternatives. And when you look at our portfolio, you'll see that there's the alternatives that we have they have that additional premium. Things I talk about is insurance. We've had a reinsurance allocation for a couple of years, which was fun last year, but it's you get paid because you're selling insurance over the years, and it's an access point into the insurance company's return stream. Real estate, which is funny, it's an alternative. It's actually multiples larger than the stock market, and we think that every client should have at least a strategic position to core plus buy and hold real estate. We also have an alternative allocation to the marketplace lending, talking about the disruption that is occurring. For so many years, banks have given borrowers or savers 2% and given credit card people 24%. There's a lot of lending clubs, SoFis, that have come in and compressed that and have given that return back to the capital markets. So we've been allocation there. And then for the clients that want to go even further out, is there are private allocations that we look to make, and as Stephanie said, those who are willing to accept that illiquidity. And we're pretty stringent on if we're going to ask our clients to lock up money, pay performance fees, and have the headaches that come with private investment, we really need to see that what we call active management beyond the point of purchase. And what that is a real estate manager that's not just going to buy and hold a building, but they're going to buy a unloved asset, put money into it, put resources into it, and try to sell it for higher, kind of a value-add component. And we do that across private equity, venture, buyout, and growth equity, as well as real assets, both real estate and infrastructure, which we think infrastructure is an interesting play with the next cycle, given the lack of infrastructure spending that has happened across the globe, Whether some predict or say that's 20 trillion or 70 trillion that need to happen. Infrastructure, private infrastructure plays a very key part in making sure that those assets get upgraded and continue to maintain. So there's if you're willing to take the illiquidity, there's a lot of interesting things out there. But to Stephanie's point, you need to make sure that that's going to be giving you additional return over what you can get in the public markets. Because it's a lot of headaches, it's a lot of K1s and signings, and you just got to make sure that that plus the liquidity fees are worth it.
I'll be pretty brief and succinct with my answer because, again, I agree with all that my colleagues have said pretty much to a T. So just to summarize, in real estate we like value add. You'll find that we are typically contrarians and like to go against the grain. So value add, a property where you can get involved as an operator or with an operator, they're going to lease it up and fix it up. Some interesting avenues on the real estate side that we've looked at but haven't done anything. Certainly some of the cannabis warehouses, so a warehouse upgrade, haven't done anything there, but that's somewhat interesting. The other one is some dislocated shopping malls. So there's been a real dislocation in shopping centres, certainly B-class type shopping centres. Agree with the synopsis on hedge funds. It was a dirty word. That's an interesting place to look. Certainly funds that are long volatility. That's also an interesting place for us. I mentioned the venture capital play in the consumer debt space, so loan services, that's interesting to us. And then natural resources, certainly like the energy and mining space.
Okay, well, thank you. We're close to time, so thank you very much for your time. You did a great job. And we will summarize everything that we have in the notes and make sure everyone gets a package and send out to the media as well. So you'll get one as well. If your media people or marketing people can help us get that out, that would be great. That was great content. Really